Following one of the most politically and economically volatile periods in recent memory, 2012 emerged as a year of surprising strength. The year started with renewed hope in Europe after the ECB's LTRO program bought time for troubled EU nations Greece and Italy and mollified concerns around the viability of the euro. Improved sentiment, coupled with better-than-expected employment data from the US, buoyed markets both domestically and overseas. The focus soon shifted to China, which reported weaker economic growth, prompting fears of a hard landing. Many believed that the resources boom of perpetually higher commodity prices, driven by higher and higher levels of Chinese construction, was nearing an end, and it became apparent that growth would be fueled by consumption rather than investment. This led to short-term equity weakness, led by resource and mining services stocks and bond strength. Global equity markets struggled, largely due to Eurozone economic and political woes. However, after 2 rounds of elections, a centrist coalition emerged in Greece. And despite Spanish bonds remaining under pressure as Madrid sought support for its ailing banking system, an EU summit late in June bolstered sentiment. In Australia, 3- and 10-year bond yields declined, and the RBA cut interest rates by 75 basis points over May and June. But the bad news was short-lived. The second half of 2012 marked a turning point for markets, driven mainly by the continuation of quantitative easing initiatives from both Europe and the US. Despite periods of political uncertainty, Obama was re-elected and a compromise was reached over the so-called fiscal cliff. The Federal Reserve announced its intention to purchase up to $40 billion US per month of mortgage debt, effectively committing to continue quantitative easing for as long as required to generate underlying growth in the US economy. And in Europe, while the ECB cut its 2013 growth forecast, manufacturing data showed signs of stabilizing. In this risk-on environment, US and UK 10-year bond yields rose, as did equity markets across Europe, the US and Japan. In Australia, the S&P/ASX 300 rose 16.1% in the second half of 2012 and recorded only one negative month over the whole year. These double-digit returns were driven largely by defensive and high-yielding stocks, with the chase for yield taking centre stage. Despite this, with Chinese commodity demand stabilising, iron ore prices falling and resource investments peaking, coupled with a strong Aussie dollar, the RBA cut rates twice towards the end of 2012, closing out the year at an almost 4-year low of 3%. 2013 saw yet more market growth. The US economy sustained its moderate recovery, with manufacturing PMIs rising, healthy payroll reports, housing market gains and lower unemployment rates. A strong February reporting season in Australia highlighted improved strength in company earnings and a boost in business confidence, driving the S&P/ASX 300 up a further 8% over the March quarter. In Europe, an election deadlock in Italy and unprecedented bailout options for Cyprus failed to stop bond yields rising both domestically and overseas. And with higher iron ore prices, a better-than-expected CapEx survey, and an improved global environment, the RBA adopted a wait-and-see approach, keeping interest rates on hold until May, when they were cut by 25 basis points to a record low of 2.75%. But what lies ahead? What form will the US recovery take? Will Europe continue to claw its way out of recession? And just how far off is the peak in Chinese commodity consumption? On a domestic front, will pressure on iron ore prices continue to cause resource stocks to lag? And will the ongoing improvement in company earnings shield us from the noise of budgetary tightening and election year political jockeying? But critically, where do the opportunities lie for investors?